the dot, and we've got a really great show today. Before we get to the rally, before we get to the OPEC cuts and everything else, we should probably, and really what you're all here for, let's be honest, Brent Johnson's milkshake theory and his opinions on where we go next. We should probably introduce ourselves. My name is Victor Jones.
I'm Chris Vecchio. How are you this Wednesday, Victor?
I've been better, man. I'm super excited. Got a little stomach bug, but I'm super excited for today's guest, and I know you are as well, man. How you doing?
I'm doing well. This is your Jordan flu game. I had mine last week. You're having yours today.
There was 0% chance that I was going to make it for this one. I'm really excited. Normally we do our whole song and dance, a bunch of dad jokes, but what we need to make sure we get right into this one, ladies and gentlemen, without further ado, founder and CEO of Untitled Capital, original native of Nebraska, by the way. Ladies and gentlemen, Brent Johnson. Brent, welcome to Jones and Friends. How you doing?
I'm good.
Welcome to the show. We are live. We've got a bunch of people, a bunch of savages in the chat who are really excited to have you and to learn from your point of view on this dollar wrecking ball and basically where we go from here. I guess before we get started, if people have been living under a rock and they're not following you on Twitter, or you're back and forth with Luke Groman, what's you want to give people your quick background?
Sure. So I started on quote unquote Wall Street back in '99. I worked for a firm called Donaldson, Lufkin and Jenrette in New York. I transferred with them to San Francisco in the year 2000, right about the time the dot-com bubble crashed. And Credit Suisse bought DLJ kind of right at the top of the market there. So I was with DLJ for 10 years. Worked with a friend of mine for a few years at an independent firm in San Francisco, and then ultimately set up my own firm, Untitled Capital. Throughout my entire career, I've always managed money for individuals. So I'm not managing pension funds or endowments. And my clients are not typically institutions who are versed in the typical financial vernacular. So a lot of times when I come up with my ideas, I'm communicating them to an individual who's maybe very smart, very intelligent, very successful, but they're just not finance people. And so I've got to kind of come up with a different way of explaining many things to them. And so throughout my career, I've always tried to come up with a little story or anecdote or analogy to explain how I think things are going to play out. So that's me.
And so I first became aware of you. I saw a video that you did. It was like, well, back in 2019, basically when the Fed started tightening. And I've been following the evolution of both your theory, which I've heard you say it's less a theory and it's more of an explanation of how the current monetary system works. I wonder if we could just start right there. If
Sure.
You can take us to what is the dollar milkshake theory, which I guess at this point is another way of asking, why is the dollar so strong, Brent?
Yeah, so it's a little bit, a couple different ways to look at it. The first thing is, yes, it's an explanation of how the system works. The theory is how I think things are going to play out because of how I understand the system works. I really use the dollar milkshake theory as a framework for how I believe markets will react when we get into a sovereign debt crisis and a sovereign currency crisis. The reason I think that we are going to get into a sovereign debt and sovereign currency crisis is because of the design of the system. And what I mean by that is, for better, for worse, like it or don't like it, the dollar underpins the entire global economy. The entire global economy runs on the dollar. And whether you like using the dollar, whether you don't like using the dollar, if you think it's used as a weapon or used for good, it doesn't really matter. It just is. That's how the system works. And it's really important to understand that all money, other than the base money, so I can't go into too much detail because we'd be here for hours, but at the end of the day, there's base money that actually exists. All other money is loaned into existence. Mm-hmm. And so based on that design, the system has to grow. If the system doesn't grow, it will crash. So you always have to have circulating, the money supply always has to be circulating. If it comes to a stop, the system will seize up and it will go into reverse gear. And if the system goes into reverse gear, it doesn't just slow down, it literally crashes. And so we've seen this play out in 1998 to 2000 with the Russian debt crisis, and then the dot-com bust. We saw it again in 2008, 2009 with the global financial crisis. We saw it to a certain extent in 2011 and 12 with the European crisis. We saw it a little bit in 2018 when the Fed was raising rates very quickly. We saw it again in 2020 with the COVID response. And then, you know, to a certain extent, we're starting to see it again now. And the reason is because for the system to operate, the dollar has to be circulating. And when it becomes more expensive to buy the dollar, it's harder to get it. It becomes harder to circulate. The circulation slows down. Everybody holds on to the dollars they have. They're afraid to give them away because they might not get them back. It's kind of like musical chairs. And so my point with the whole dollar milkshake theory is not that the US dollar is a good currency. It's not that we have a good system. It's not that we are the moral authority and we do things better. It's just that in many ways, the system is designed, it's rigged, for lack of a better way of saying it, in the US's favor. And the reason it's rigged in the US's favor is they set up the system. It's really no different than if you started a company and you're the chairman of the board, you're going to put your own friends on the board with you. You're not going to hire a bunch of people on the board who disagree with you. You're going to put people on the board who are going to back your opinions. And that's what the US did. And they set it up in a way that would, you know, benefit the US post World War II. And you're largely seeing a lot of that stuff play out now. And, you know, I've made the comment that because the dollar underlies the entire system, all other currencies are really just derivatives of the dollar. Now, if there was a parallel system where another currency was widely used or as widely used as the dollar, then that wouldn't be the case. But it's not the case. And every country on earth uses the dollar not only to transact in, but most of them use it to fund businesses, lines of credit, projects in dollars. And so there's a demand for dollars that just doesn't exist for any other currency. And that is what we're seeing playing out now. The demand is outstripping the supply.
Brent, when we talk about the dollar being this primacy, this base of the financial system, one of the things that comes up quite frequently in certain circles is that the time for the US dollar to be the world reserve currency is coming to an end. I don't think that you would agree with that, though. It's not that the dollar is a good currency, as you already noted, but it's maybe perhaps a lack of viable alternatives. What's your take on that whole conversation?
Well, so it's kind of twofold. It's not that I don't see the effort being made, and it's not that I don't believe that there's a desire on the behalf of other nations to come up with a different system or leave the dollar system. Where I start to have a problem is the likelihood of it actually succeeding. And then not only that, but even if it did succeed, the interim period of the transition from this system to another system, I believe would be chaotic, probably not just economically, but militarily. And in that chaos, I think you would see the dollar go higher rather than it go lower. So even if we are transitioning, even if I'm wrong and the US is going to lose the global reserve currency, let's say in the next couple of years, I don't think that would be a smooth transition. I don't think it would be a transition where the dollar just goes from where to 110 today, you know, to 100 to 90 to 80 to 70 in just this very smooth, non-volatile fashion. I think it would be very chaotic. And I think in the short term, they would push the dollar higher. So I really don't think there is a way for the system to change without the dollar going higher before it ultimately goes lower and loses its status.
Yeah, Victor, that's a great point, because people think about the British pound losing its, you know, role as the world reserve currency. It took World War II to do that. That just didn't happen overnight. That wasn't just something that materialized out of thin air. That was a process that took place over a number of years and with war.
Yeah, and not only that is, I don't believe, and listen, I can always be wrong, and I should have said this at the very, very top. Maybe I'm wrong here. Maybe there's some plan that I haven't figured out, and there is a way to transition this that isn't volatile, and you know the dollar just goes lower, and I'm totally wrong. And if that's the case, I'll have to deal with that, right? And I'm kind of prepared to deal with that already. But going back to God, I kind of lost my train of thought there. What was the point you made?
Oh, that, you know, we're going through this transition. It took a big event like World War II to dislodge the British pound from its primacy, right?
Right. And so I think that same kind of thing would happen again or would have to happen again before the US relinquished the global reserve currency. And the reason I say relinquished is because these things are never handed over. And in the last couple of years, there's been a couple of studies and a couple of papers and a couple of people have, made comments or given speeches about how the extraordinary advantages that we have as a result of having the global reserve
Exorbitant
currency,
privileges.
the exorbitant privilege has become the exorbitant burden. And because it no longer benefits us economically to have the global reserve currency, we would like to hand it off or transition to a multipolarity or whatever it is. And in my opinion, that's completely wrong. Now, maybe I'm wrong, but in my opinion, that is completely wrong. And the reason I think it's wrong is I really don't think global reserve currencies are so much about economics as they are just about geopolitics and power. And I think if you're just analyzing the global reserve currency and the situation that the United States is in from an economic perspective, then I can kind of understand coming to that conclusion. But the global reserve currency is not just about economics. It's about power. It's about geopolitics. It's about imposing your will. It's about setting up a system that favors you as opposed to others. And I just don't believe that the US or any other country for that matter would willingly do it. When the US took it from Great Britain, it was relatively peaceful, at least between the United States and Great Britain. But it took like you said, it took a world war for it to happen. And I'm sure that the UK really didn't want to do it, but they really didn't have a choice. They were kind of facing an existential threat and they needed the US's help, and the US drove a very hard bargain. We didn't just for the fun of it decide to go over to Europe and fight the Nazis. Like, we drove a very hard bargain. We took basically 70 or 80% of the UK's military bases. We took a number of their strategic locations around the world. We drove a hard bargain as far as what they would have to pay us to get involved. And so it was done peacefully militarily between us, but it wasn't done peacefully economically between the US and Great Britain. And I wouldn't expect that to change this time. The other thing I would say regarding this is in my opinion, there's really nothing that the rest of the world could do to make us lose, short of beating the United States in a war. There's nothing the rest of the world could do to bring the dollar down that the US didn't already do over the last 2 years. If you think about everything the US did, when I say the US, the government, the Federal Reserve, the monetary authorities, the trillions of dollars of QE, the helicopter money, the stimulus, not only that, there was a point where Donald Trump was saying we need to get the dollar lower. There was an insider trading scandal at the Fed. We had riots at the Capitol. All of these things that you would think would cause people to lose faith in the dollar. And yet here we are at 20-year highs. And in my opinion, the reason is there's just lack of substitute. There's just really no other choice. And not only that, if people did, like in mass, try to go another choice, I think the US would react militarily to that. And some people don't like me saying that, but I think that's just a given. I'm a little confused as to why that's so controversial, but I think that's a given. And so I just don't think that there's, these ideas that the BRICS are going to get together and they're going to launch this parallel currency and everybody's going to stop using the dollar and start using, a basket of currencies that the BRICS nations put together. Again, it's kind of like me announcing to the world that I'm going to become the greatest golfer in the world. Yeah, it's a great announcement, but I don't think anybody's going to put money on me actually doing it, right? I could quit my job. I could go practice 10 hours a day. I could really commit myself to doing it. But it doesn't mean it's going to happen. And not only is it not guaranteed to happen, but there would probably be a lot of economic hardships, for me in the short term. I'd lose my job. My clients would leave. My family would probably lose me or leave me. My bank account would go down. I'd have blisters on my hands. There would be pain involved in me even attempting to do that. And it would be the same way for these other nations. If they, stopped using the dollar and launched this parallel currency, it's not just going to happen in a peaceful manner. And even if it happens in a militarily peaceful manner, it won't happen in an economically peaceful manner. There would be a lot of pain involved in that. And so, I just think it's a little bit too little too late. And the analogy I would use is, let's use the green revolution, right? We're going to transition from using fossil fuels to solar and wind and these green energy projects that are more environmentally friendly. And so, over the last, call it 5, 10, 15 years, governments around the world have imposed regulatory constraints so that businesses have to start this transition. That's great. It's a worthy goal. The problem is now we've run into this energy crisis and we've hit the wall, right? Mm-hmm. And you see energy prices go through the roof, and there's tons of pain as a result because these new green projects have not actually come online yet. It's kind of the same idea when you think about these parallel currency systems. It's great to have these ideas. You've heard about a number of these. We're launching this project, or we're getting ready to do this. But I believe that we're going to hit this wall before those programs are ready to go.
Yeah.
And so, and I think when we hit those walls, which, you can see when the Bank of England intervenes in the market, that's them hitting the wall. When the ECB has to do QE and launch and raise rates at the same time, that's hitting the wall. When the Bank of Japan has to intervene, that's them hitting the wall.
You've explained this in the past as sort of like this three parts to your theory. You start with dollar strength, you then start to see international and emerging markets pain, and then it eventually ends in effectively a currency crisis. And so you just brought up some of the reaction functions that you've seen out of the Bank of Japan and the BOE. I wonder if you could speak to, if somebody's not as familiar, right, Brent, if they're not as familiar with, you took us through the debt-based monetary system, you basically set the table there. You started at Bretton Woods, moved on, we left the gold standard, all these things. What is the reaction function that's happening now, starting with the Fed, that they're doing, that then creates this pain? We've said for a long period of time, for the past 40 years, you buy bonds and wear diamonds, right? We're exporting our inflation to the rest of the world. And all of a sudden, some of the things that have underpinned perhaps us seeing a period of deflation while we've been printing fiat after leaving the gold as the gold-backed dollar. What is the reaction function right now that's playing itself out, that's creating the international and emerging market pain?
Yeah. So let me begin. I'll start at the base, and I'm going to take some big steps, but it'll help. So remember at the beginning, I said you have base money, and that's it. Every country in the world basically has the same monetary system design, and all the central bankers, they all went to the same schools. They all know each other. They all run the same programs. They have their own slight little variations, but the design is essentially the same around the world, and that is, there's base money, which is reserves at the central bank and the physical currency in existence. And then that is used as the collateral to loan new money into existence. Mm-hmm. And as I said, the system has to grow in order to survive. And so when it grows, the way it grows is debt is extended, credit is extended, credit is debt. And so if you think about it, the system has to grow. And so the debt has to get bigger and bigger and bigger and bigger and bigger. Now, in the very short term, debt is inflationary because you're putting more money, more funding, more projects, and it accelerates growth. You get and you get these inflationary pressures due to growth. But ultimately, debt becomes deflationary because more and more of the revenues of whatever project go to service the debt. So where we are at okay, so that's step number one. Step number two is, because the US is the global reserve currency, and we don't just use the dollar in the United States, most people are familiar with the dollars in the United States and the dollar debt that the United States has, but that's the US domestic dollar market. There's also this parallel economy, or this intertwined economy, has spider webbing, however you want to define this. Dollars that exist outside the United States are called euro dollars, and the market for dollars outside the United States is called the euro dollar market. And the euro dollar market is orders of magnitude bigger than the US dollar market. And it has to be, because it has to grow to function. So if the last time somebody tried to measure the euro dollar market was like 25 years ago. And at the time, their best guess, because it's really hard to measure, is that it was like 35 to 40% bigger than the US domestic market. And since you know that the system has to grow, not to collapse, and you think about how much the US system has grown over the last 25 years, then you know that the euro dollar market had to grow even more than the US system. So there's this whole system of dollars outside the United States that's even bigger than the system inside the United States. And that system involves US dollar debt. And it involves the interest rate. Since it's US dollar denominated, it's also the interest rate goes along with whatever the US interest rates are.
Right.
So over the last, however many years, there is all this dollar debt that exists outside the United States, issued by entities that are not US entities. So it's not their home currency. And so when rates are, when the Federal Reserve raised rates in the United States, they're not just raising rates on the US, they're raising rates on the whole world because the whole world uses these euro dollars.
Mm-hmm.
And that's fine if the whole world is growing together, but it's not fine when the US is in one position and the rest of the world is not. You get into this thing that's called Triffin's dilemma. So Triffin's dilemma, I think it was come up with back in the 60s or the 70s. And it basically says that if an individual country's currency is also used as the global reserve currency, you will eventually have a situation where the needs of the domestic economy come into conflict with the needs of the international economy. And that's exactly what we have right now. We are smack dab in the middle of Triffin's dilemma. Because of the
World
inflation,
Bank, the UN, the World Bank, the UN, we've seen recently, IMF, you've started to see these world organizations ask the Federal Reserve, can you please stop doing what you're doing?
That's exactly right. That's exactly right. And the reason is this conflict. Now, Jerome Powell, he is not the central bank head of Bangladesh or Ghana or El Salvador or China or England or Japan. He is in charge of domestic US policy, right? And so the needs of the domestic economy say we need to tighten, or at least he believes that his view is that we need to tighten monetary policy in order to rein in the excesses from the stimulus we provided during COVID. And he's very clearly said, we need people to lose their jobs and we need them to get paid less, right? I mean, he didn't come out and say it quite that bluntly, but that's basically what he says. He says, we are going to need to have some pain to rein in inflation. And the way that you rein in that inflation is you raise rates and you tighten monetary policy. Well, this is putting an incredible amount of pressure on the rest of the world. And the reason is because this is why we've got this, these counterbalancing forces is post-COVID, the whole world saw inflationary pressures, right? And now many countries around the world are feeling these inflationary pressures and their input costs are going up at the same time that global growth is slowing. So their revenues are coming down and their expenses are rising, right? Their input costs are, so they're getting, the profit margin is getting squeezed, which is putting pressure on their home economies. Then on top of that, the dollar is now 20% more expensive than it was a year ago. So it's like a 20% kicker on top of the problems you're already having, right? And the way that they then, whenever a country typically gets into a problem, as far as slowing growth or slow economic malaise, what do? They quote unquote, without getting into too many details how they do it, they print money, right? Or they provide stimulus. Well, so now we have a situation where the dollar is getting stronger, the input costs are rising, the revenue's falling, and we have this energy spike because of the, what we talked about earlier. And what's energy priced in? Energy is priced in dollars. So not only is their US dollar debt more expensive, their energy to even run their economy is more expensive. And so these other countries are printing their own currencies to then use that money to go buy dollars to then buy oil or whatever it is. And so as they're increasing the amount of their currency in the system, their currencies are falling versus the dollar. And it becomes this vicious feedback loop where the dollar strength begets more dollar strength. And so there's really no good solution here. I mean, to put the real topper on it is that because all of these countries, including the US is not immune to this, by the way. We're just in a better situation than everybody else. But because so many entities and governments and corporations and individuals borrowed so much money when interest rates were either at zero or even negative, when interest rates go up even a little bit, it becomes harder to service that debt. And I think everybody understands that. But even more important than that is all of this debt that was issued by these governments and corporations and individuals was also purchased by banks and institutions and individuals. So those liabilities is also somebody else's asset, okay?
Mm-hmm.
So now as interest rates go up, those assets are going down in value. And so what's happened, let's use Japan as an example. So Japan has been trying to get inflation for 20 years to no avail because of all their debt. Well, now they've borrowed all of this money at zero rates or negative rates. So their banks, their insurance companies, their pension funds, their endowments, individuals are chock full of Japanese government bonds that don't yield anything. And so now as interest rates have only gone up a tiny bit in Japan due to the inflationary pressures, they went up 25 basis points. And it caused such a problem that the government couldn't allow that to happen, just 25 basis points. So what they've had to do, they've had to go in, because if interest rates go up, then the banking system comes down, because all those insurance companies and banks and endowments that have those assets, those bond assets at zero, as interest rates go up, those assets come down. And so it would cause a crisis. It would cause a default en masse, right? So they can't let interest rates go up, because then you get a banking system collapse in Japan. So how do they counteract it? They go buy those government bonds to pull the interest rates down, but then they're putting more money into the system. And so that's how the yen is down 20% in a year. But now the yen is so weak, that's a problem too. So now they're trying to intervene to keep the yen from getting too weak, but they're also intervening to keep the bonds price. So something eventually has to give. Now they can play this game for a little while, but eventually one of them is going to break. And typically history says it's the currency that breaks.
When I play this out in my mind, why I'm a little concerned. A little concerned is probably an understatement, but if I play it out to one direction, Brent, you go, okay, what if they leave rates higher for longer, and you start to see unemployment tick up? You will see the effects of higher rates on the economy over a long enough period. Then the reaction function from a fiscal point of view, when you have historically, is you run higher deficits to try to prop up whatever issues that you may be having or help people out through difficult times. And the problem with that is your debt expenses are going to get higher and higher and higher the more you try to do that. So there's your problem on your higher for longer end. And then if you try to, let's call it the other end, you try to solve the problem the way you've always done, the sort of the hope of the printer being turned back on. Now you reverse your inflation problem. Now you're sort of devaluing your dollar, and you're also no longer in, as Jem Carson called it, a cooperation game. We're in a competition game. OPEC's cut of 2 million barrels today should pretty much put people on notice of what is happening in the world right now. And that if you're in a period of maybe short-term cyclical deflation, we're perhaps in that period of secular inflation over a longer period of time. So it's like, you've mentioned this before, I like to play cards sometimes, and you want to know what hands in the deck can make your hand, or what cards in the deck can make your hand. And I'm having a hard time finding the card that makes the hand, Brent. Is that a fair assessment?
It's absolutely a fair assessment. And, I've said many times, I really don't know how this plays out. My whole milkshake theory is my thesis or my ideas or my guesses how it's going to play out. I don't know. I don't know how it's going to play out. But what I do know is that this is not a solvable problem. And what I mean by that is there's short of resetting the whole system, which I think they will eventually have to do. There is no decision that can be made that will solve this problem. It can only kick it down the road. And so whether, this crisis plays out over the next 2 years or the next 20, I don't really know. My guess is it's closer to 2 than 20. For all the reasons that we've been talking about. And not only that, is that even if there was a way to do it, I think the likelihood of them being able to pull it off is pretty low. Again, let's use the golf analogy again. Let's say Tiger Woods is on the 18th hole at Augusta and he hits his drive and he's into the woods, right? And he's still got to hit the second shot out of the woods onto the green so he can make a birdie to win the tournament. Now, I'd probably rather have Tiger Woods hitting that shot than anybody in the world, but I'm still not going to bet too much money on Tiger pulling it off, right? And I don't think that the central bankers and the leaders and the presidents and the politicians that we have right now are anywhere near as good as Tiger Woods is at golf as they, in their respective fields. So I just don't have a lot of confidence that the people who got us into this mess are going to get us out of it. And if they can't get us out of it, then we're going to have a crisis. And if we're going to have a crisis, then the dollar is going to go higher. And when the dollar goes higher, bad things happen.
Right. Well, if we're in the midst of a crisis, you mentioned that we probably need something to break for people to come together and fix it. There's no solution here in the near term. But is the solution another Plaza Accord? Do we need another global coordinated intervention to weaken the US dollar before this dollar wrecking ball destroys the global economy and the financial system within?
Yeah.
And by the way, can you take us back and sort of explain what, just in case people aren't as familiar, I find with monetary history. So a lot of people are referencing Volcker and the Volcker era, but not as many people referencing what happened to the dollar during that period and ultimately what had to happen in 85.
Right. So short answer to Chris's question is, I think ultimately that is what's going to be needed. Some kind of a Plaza Accord. Now, whether it's done exactly the same way or in similar fashion, or if it's done on a bilateral basis with a number of countries involved, or just a unilateral basis by the United States, I don't know. But I do ultimately think the only solution is to kind of reset the system either via Plaza Accord and have it be, in many ways, the Plaza Accord kicked the can down the road too. It didn't really solve it. But let's talk about what the Plaza Accord was. And then remind me, I'll tell you why I don't think we're going to have a Plaza Accord yet. But essentially what happened is in the 70s, in early 1970, the US, in order to fund all the government programs in the Vietnam War, they removed the dollar's convertibility to gold. And that allowed them to print more money and finance these programs. And we also had stagnating growth. And so we had high inflation. And so we had, by the time 1980 gets around, Jimmy Carter, presided over 4 years of very high inflation. Ronald Reagan came in and said, we need to get rid of Carter and we need to make things better, right? Mm-hmm. Well, so then he got in there and then they started raising rates. Volcker became the Federal Reserve chairman, started raising rates to squash inflation. And everybody said he's not going to keep hiking, but he just kept hiking and kept hiking and hiking. So from like 1980 to like 1984, I don't know how many times he hiked, but at some point, along the way, like mortgage rates were like 15, 16, 17%. You could get double digits for being in a money market fund, right? Which is unheard of today. Mm-hmm. And so, but what that did is that made the dollar very, very strong versus the Deutsche Mark, the Japanese yen, and its competing currencies. Well, now it's 1983, 1984, the dollar's very strong. The economy's kind of sluggish and Reagan wants to get reelected, right? He's a very popular president, but he also, he's not immune to, a slowing economy. So at some point in 84, 85, the Fed basically went to the other central banks and said, listen, we are going to systematically devalue the dollar. We're not going to do it unilaterally. We're all going to do it together. And over the next, year, 2 years, you're going to go out and sell dollars and we're going to go out and buy your currencies. So your currencies are going to get stronger and ours is going to get weaker. And we're going to do this in a coordinated fashion. And that's just the way it is. And I'm sure that Japan and UK and they probably didn't love this idea. They probably didn't hate it as much because, again, the strong dollar is tough, but these are exporting economies. Mm-hmm. For their currencies to appreciate 20 or 30% and still be able to export, it's hard for them to do, right? And so, but the US said, this is what we're doing and we're going to do it. And so then over the next couple of years, the dollar went from, the DXY index went from like 165 down to like 100 or something, so this massive, 20 or 30% devaluation of the dollar. And so that brings us to today. we had this big period of, or the last couple of years, we've had this big inflationary storm. Now we've got a central bank head who is raising rates. And the dollar's getting very strong, and it's hurting the rest of the world. And so, now the natural theory is, well, what do we need to do to weaken the dollar, right? So let's have another Plaza Accord. But if you think about it, the Fed and the US is the one that drove the Plaza Accord. It wasn't the rest of the world that said, hey, we want to make our currency stronger and the dollar weaker. It's the US that drove that. So for the Plaza Accord to happen again, the US would have to want the dollar to be weaker. Well, if the US wants the dollar weaker, then just go do QE or go do all these programs again that they did post-COVID. But the US doesn't want the dollar weaker right now. They want it stronger because they want to kill inflation, right? The rest of the world might want a weaker dollar, but the US, Jerome Powell doesn't want a weaker dollar right now, at least not a dramatically lower dollar, because sorry, I don't want to get too confused with people, but if the big problem right now is the inflationary pressures, Powell wants a stronger dollar to crush inflation. He's trying to kill demand. If he makes the dollar weaker, that helps demand. That probably increases the inflationary pressures. So a Plaza Accord right now would go totally counter to everything Powell has talked about for the last 9 months. So, and not only that, I think, again, from a geopolitical perspective, I think the US government, I think the US Treasury is more than happy to have a strong dollar. Because
can I ask you?
Yeah.
Oh, go ahead. Sorry.
No, go ahead.
Well, I wanted to ask you, there's, from a contrarian point of view, and it's hard, if you're a contrarian, or if you're a trader, sometimes you want to be on the opposite side of the boat that everyone's on, right? It's hard to look at the dollar index right now and go, man, I got to get on that trade.
Yeah.
How do you think about, to use your sports analogy from earlier, but I'll go to baseball. Like, if you got a bunch of people out here who are looking at the Dixie and they're going, this is the 9th inning. Why should I not be fading this thing right now? Especially you look at equities rallying, you look at, you had a bit of a bond bid until today. But how do you view where we are in this theory?
Well, I'd say in the very short term, I don't have a problem with people fading the dollar. I mean, it had a really big run, up 20% in a year. It's due for a breather. I even tweeted something out last week that said, hey, this is, this isn't the beginning of the end, but it might be the end of the beginning, to use that famous Churchill line. This is a natural place for the dollar to kind of take a pause. Governments are kind of now coming out and starting to intervene in their markets. Governments are very good at pushing markets around in the short term. In the long term, I don't think they're very successful. But in the short term, they can be very, very successful. Not only that, but like that, I think the US wants a strong dollar and they want the rest of the world somewhat in a vulnerable position, but they don't want a systemic collapse either, right? So maybe Powell does take his foot off the gas a little bit, and maybe the dollar strengthens or weakens for a couple of weeks or a couple of months. But what I would say now is the same thing I said in the summer of 2020, after the dollar made its big run, or in this first quarter, and then it started to pull back in the summer of 2020. I said people should use this as an opportunity to get out from underneath their dollar debts and their linkage to the dollar, but they won't. And what they did is they doubled down. Countries around the world issued more dollar debt. Corporations around the world issued more dollar debt. They signed up more trade agreements in dollars. They increased their business lines of credit in dollars. And so the problem today is even bigger than it was in 2020. And so the point I would make is, if we get a couple weeks, couple months, maybe we get a year of dollar weakness. I don't really know, but I would use that as an opportunity to get out from underneath your dollar debts rather than double down on it. But I'm pretty sure that the world will just double down on it. And in 6 months or a year or 2 years, we'll be right back to where we started. Because again, you can't really solve this problem. Solving the problem causes paying off all the dollar debt. First of all, they couldn't do it. But if they did do it, that itself causes lots of volatility, because that's a monetary contraction. Debt is money. So if all that debt disappears, you're getting a monetary contraction. So like, there's just no good solutions here. There's no good decisions. It's just what's the least bad decision at this point. And so to those who want to fade the dollar here, one thing I would say is going back to QE and weakening the dollar does not kill the milkshake. It actually is part of the milkshake, because I don't think this is going to play out over the next 2 or 3 months. I think it's going to take 2 or 3 years, maybe 5 or 6 years. And I expect during that time period, there will be periods of dollar strength and dollar weakness, and dollar strength and dollar weakness. I just think we'll set new highs and then new higher lows, and then new higher highs and then higher lows, and it'll be a stair step higher. But it wouldn't shock me at all if the world goes back to QE. The dollar weakens for a little bit, but eventually the rest of the US doing QE is just going to force everybody else to have to do QE even more.
Well,
I mean, if you think,
oh, go ahead.
Yeah. No, I was just going to say, like, the rest of the world, they don't want the dollar to be spiking, but they also don't want the dollar to crash. If the dollar crashes, then that means their currencies are spiking. And if their currencies are spiking, then they're going to have a harder time exporting. Right. And so you need this, Dalio called it the beautiful deleveraging. And I think the likelihood of the global monetary leaders pulling off a beautiful deleveraging, I think, is extremely low. It's not impossible, but I think the likelihood is low. So if the US comes out and does QE again, I would expect the dollar would get weak in the short term. But then eventually that would lead to more inflationary pressures, and then they'd have to start tightening again, and we'll end up right back where we are.
Speaking of inflation, everyone has said that gold is no longer a viable inflation hedge. That may be the case in the US here today. But when we look at gold in other currency terms, it's actually done quite well this year. I mean, gold in British pound terms hit a new yearly high, a new all-time high just last week. People are pulling back. Can we see a world in this dollar milkshake theory paradigm where both gold and the dollar rise moving forward?
Yeah, I mean, ultimately, I think that's where we're going to get to. And you know, that's a good point you bring up, and it's one I try to highlight as much as I can, is that it kind of depends on where you're at, and whether you're a dollar-based investor, or whether you're a yen-based investor, or a pound-based investor, or yuan, or whatever it is. But to your point, gold and silver have done really well in other currencies. And if you think about it, that's what gold is supposed to do. Gold is supposed to do really well when your governments or when your home currency gets in trouble. And so it's doing really well in yen, and it's doing really well in euros and pounds, because those currencies are in trouble. The reason it's not doing so great in dollar terms is the dollar is not in trouble. Now, you may think it should be in trouble, and you may hope that it gets into trouble, and one day it probably will get into trouble, but today is not that day. So gold doesn't need to be doing well in dollar terms right now. But I do think that we will ultimately get into a situation where the demand for gold is high enough from the rest of the world, and it's high enough from the United States, more as a chaos trade than it is an inflation trade, where you will see both gold and the US dollar rising versus all other currencies, and probably rising versus many other assets. Yeah, that's kind of that's kind of the end game. And then ultimately, I think gold will do even better than the dollar.
It might seem strange for people, because when they think about the inverse correlations between dollar and gold, that might not seem intuitive. But at one point coming into this year, probably the stock bond negative correlation, breaking down as much as it did, that probably didn't seem intuitive either. Brent, you've been incredibly generous with your time as well as your knowledge. We appreciate it. Do you mind? We've got a little segment on the show we like to do. It's called the hot seat. We'd like to put you in it and ask you whether you lean long or short delta on a few asset classes or a few assets. You down with that?
Sure. Great opportunity for me to be wrong. Go for it.
All right, man. All right, man. We're on a 3-day face ripper rally in the S&P 500. I shouldn't say a face ripper rally today, but it did recover off the lows. 37.95. Would you lean long or lean short delta in the S&P, and why?
Well, we sold all our puts and we bought calls last week, so I'm leaning long right now.
Well done.
I don't know how long it'll last, but so far so good. I think everything got so oversold last week on a number of different indicators. And, there's only 4 other times in my career where I've seen sentiment and positioning get more offsides than it was last week. So I think at least in the short term, we're getting a bounce. I reserve the right to change my mind, but as of right now, I lean long.
Brent Johnson is an options trader. There you go, everybody. Let's talk yields for a second. I don't know if you have really strong position or opinions on yields, but lean long, lean short, and you can go anything here. You can go 2-year, you can go the long end of the curve in the 10 or the 30, or you can tell us how you feel about the 210 inversion, or all three if you want.
Man, I actually stay away from bonds because I just really don't know. If you're making me pick, I'll say that yields are going to go down for a little bit. But
yeah, perhaps a better question is who buys the debt? Maybe that's a better question.
Yeah, well, and I think the even better question is which country are you talking about? If you're talking about the US, I think people still show up at auctions. Foreigners have shown up at all the auctions this year. And, the indirect bidders at Treasury auctions have been really high this year. So I don't think the US is in trouble of not being funded. Now, if you're talking about Japan or Europe or the UK, that's a different story. They're still buying government. The central banks of those countries are still buying bonds, whereas in the US, they're not.
Good point. I am about to ask the proprietor of the dollar milkshake theory for a short-term opinion on the dollar, and I think this might make some waves on social. Brent Johnson, the dollar milkshake theory, long-term dollar bull. His short-term opinion: lean long or lean short U.S. dollars right now.
In the very short term, it probably weakens a little bit. That's what's part of, like I said, last week, it got very overbought. Equities and risk assets got very oversold. It's due for a little bit of a pullback and a pause. So I would say that, the pullback over the last week hasn't surprised me. It wouldn't surprise me if it lasts for a few more weeks, even a few more months. But I would be very careful shorting the dollar.
Have you thrown out a number? I think I heard you say we might get to levels that makes 150 in the Dixie sound cheap. I think that's the only price that you've thrown out.
That does sound like something I would say. I for a long time I've used the 150 number just because it's a kind of a nice round number, and it's a little bit lower than the all-time high. I actually think we'll go over 150 before this is all said and done. I think we're going to see the dollar at heights that people just don't think possible.
Ooh, that's some bear porn for you. All right, let's go energy for a second. Crude oil today, 2 million barrels per day cut from OPEC. Your short-term opinion: lean long, lean short energy, crude oil, WTI.
I think in the next few weeks, oil is going to be lower. I don't know about the next few days, but over the next couple of weeks, I think oil will be lower.
Interesting. Very interesting. And then lastly, we'll ask you how you think about Bitcoin. Lean long or lean short, flirting with the 20,000 level?
I lean short.
Interesting. Well, Brent, like we said, man, we really, really appreciate you coming on. We get an opportunity to talk face-to-face with people that help form our worldview. You do a ton of work out there. You put out a lot of your own knowledge and experience, and we wanted to say thank you for doing that because you've helped us to understand the world around us. If people want to follow you, if they're not already following you on Twitter and social media, or they want to find out more about what you guys do over at Santiago Capital, tell the people where they can go.
So my website, santiagocapital.com. It's really just a landing page with contact information on there. So if you want to get a hold of me, you can find it there. I'm very active on Twitter, as you said. You can look me up as either Santiago Capital. The handle is at Santiago AU Fund. You can also go to Google and YouTube and just do a number of searches for either Santiago Capital or Milkshake Theory. And surprisingly, you get a lot of, at this point, there are a lot of links out there, which, I kind of find it amusing to a certain extent, but to the extent it helps people, I'm glad it's there.
All right. Everybody, throw your emojis in the chat, hit the like button, and show some appreciation for Brent Johnson. Brent, thank you very much for stopping by. Appreciate it.
Thanks for having me. I appreciate it.
For sure.
Brent.
Chris, I think we still got, we'll still keep this thing going for another 40 minutes or so.
I got to jump, guys.
All right. Take care.
Bye.
Thanks, Brent. I was really looking forward to that conversation, and it did not disappoint, man. I think understanding sort of the monetary history and understanding the monetary system, in my personal opinion, it's important and especially helpful And you start to see these like recurring themes, you know. Jem Carson came on, he talked about the 68 through 82 period from a vol point of view. And then you realize like some of these thoughts that are out there, they all take us back to a time of structural or secular inflation and the knock-on effects that happen from that. Like there's sort of this recency bias that this is just going to go away. You know, we're going to give it a couple of weeks of volatility. This is all going to go away. But perhaps a better way to think about this is, what are the knock-on effects? And I think it's helpful, even if you disagree. I think it's super helpful to understand the history for sure, Chris.
You know, I know some people out there perhaps eschew or even ignore some of the longer term monetary history, because you say, what is something that happened 40, 50 years ago? You guys are talking about World War II. And we even flirted with discussing John Maynard Keynes' solution to transitioning away from the British pound, the banker, which was, I guess, the IMF's SDR before the SDR existed. But the point is that we're human beings. We're wired biologically the same way we were 50 years ago, 100 years ago, 2,000 years ago. Our neuroanatomical structure has not changed in a material enough fashion to suggest that we're governed by different emotions. And so market psychology moves in cycles, right? We've probably seen this before. It's just different characters, different clothes, different technology, but the movie story is more or less still the same. And so learning the history is very important, because despite what some other people think, and I know that there are even people on Tasty Trade who don't think that fundamentals and the narrative matters all that much. But I will say, like, the way I view that is, if we're going from New York to LA, we need to know that we're heading from east to west. And if you can kind of get your head around where we are in terms of a historical analogy, you can use the history as somewhat of a guide of how you should be trading. Should I be trading long delta, short delta? Should I be using a lot of leverage, or more focused on risk management and protecting my capital now? Understanding the areas in which you are operating gives you a greater chance of succeeding. A lot of it is noise. A lot of it may be irrelevant, but at least having that library of knowledge will set you up on a foundation towards success longer term, in my opinion.
I agree. I think the bigger difference between those points of view, sometimes, like the macro point of view tends to not trade in 45 day cycles, right? So if you care about the macro, you probably also put on positions that have longer time frames, and you give yourself longer time for those things to work. If you're trading in 45-day cycles, it's hard for a deeper macro point of view to play out within a 45-day cycle. And I think that's sort of the difference. And I think there's probably room. I just personally like to be informed about the macroeconomic conditions. I like to be informed about monetary history. I'd like to understand maybe some currency cycles, monetary regime. I like to understand all of those things, even if I'm trading on a short-term basis. But a fascinating conversation with Brent Johnson, excuse me. Do us a favor, everybody out there. I'll drop the Twitter link in just a second, but hit the like button. You guys are the reason we're able to continually book more guests. So we'll put out some links from this conversation on Twitter. Do us a favor, help share those things if you're seeing this later on. Let's talk markets, man. We still got about half an hour. Let's talk about the crazy volatility that we saw today. Let's give people a lay of the land. E-mini S&P 500, 37.95, down about 0.5% on the day. They are closed. We're in that 1 hour, 1 hour period where they
turn back on the machines.
They shut the machines off. We did not end green, but from where we came from, you can pretty much, it's a pretty positive ending to today's story. The NASDAQ down about 0.1%. The Dow Jones down about 0.1%, and the Russell was the underperformer on the day, down 0.2%, man. It pretty much came down to that OPEC announcement. I think the OPEC announcement came out. You start to realize if oil inflation becomes sticky, what does that mean for bonds? What does that mean for interest rates? What does that mean for people's demand for debt in that world? The long end of the curve dropped 2 points instantaneously, and it weighed the market down. And then for one reason or another, the market found a reason to buy them. I don't want to speculate as to what that reason is. I don't think you need one. Well, what was your opinion of market pricing today, Matt?
I think it was a heck of a comeback by markets in the second half of the day. We start the day lower, as you noted on the back of that OPEC news, not giving us a 1 or 1.5 million barrel per day cut, but a full 2 million barrels. That's a little bit more than what the chatter was ahead of time. And certainly you're seeing it in crude oil prices. You're seeing it, by the way, in U.S. domestic producers. ExxonMobil having a very strong session today, plus 4%. XLE,
Energy
another
is on fire.
energy, another great day. Pays to be an oil man, Vic. And one of the reasons why I've stuck through is because supplies are simply dwindling. And I think I stated this on Monday. You know, the sentiment and everything negative felt like it was priced in. So why rebalance? Like, why move away from what's been working? And, you know, patience is being rewarded here the past several sessions. I think that's something that can certainly continue right now. And technically speaking, it does appear that we did break the downtrend from the June and August swing highs in oil prices. So if that gets a little bit of run, we're starting to see gasoline futures get a little bit of a run here as well. That's good news for the energy sector still. How far it can run before it becomes an albatross around the market's neck is another question. You know, if we're up around 90 or $95 per barrel, that's one thing. But if we start to go 100, 105, 110, the market probably becomes an inverse oil trade once more, like it was for so long this year, because of fears of how that could roll over into the inflation picture and thus influence Fed thinking on raising interest rates. I do think that today's price action overall was a nice breather after what was a rip-roaring two-day rally. We covered the stats yesterday. This was, what, the 11th or 12th time in history that we had seen back-to-back gains of 2.5% or more in the S&P 500. A lot of those did occur in bear markets. They didn't necessarily mark the bottoms. Half the time it was in the middle of a bear move. The other half of the time was basically at the low. So there was something to work with here. I'm not getting overly bulled up right now. I didn't, liquidate all of my, short XLY position, for example, the rest of my short ARK position and go long into Bitcoin and basically all growth. For that very reason, I'm still skeptical that this is the low until the Fed pivots. But you have to feel you have to be inspired, at least encouraged by today's bullish side of action, particularly what I think is it's a little bit of a bear trap heading into the close today, where they faded the market in the last 45 minutes of cash equity hours.
I think this thing doesn't stop until people stop calling this a bear market rally. So this could be the mother of all bear market rallies till it makes you guys all a believer again. And then we roll.
Well, that kind of happened to me after July, right? Because what happens you get to the middle of August, and it's like, hey, we're 20% off the lows. I guess we're technically in a bull market now. And bam, once everyone stopped thinking it was a bear market rally and thought it was the era of a new bull market, it got smacked lower. So I agree with you. This thing can run up probably to its 200-day moving average. And until people, stop with all the naysaying, it will run. And then the second everyone switches and gets on board and says, hey, there's another 20% off the lows, here we go back again into the meat grinder. But that fits with our view, as we've articulated the last few weeks. The rest of the year is probably going to be a lot of sideways chop.
All I know is, the thing is, I don't really care. In the short term, I don't really care. I'm just not going to get super optimistic. And here's my thing. Like, these ranges are absolutely insane. Active or passive management is not really working, right? The bond stock correlation has completely broken down for 3 quarters now. But if you throw that junk out of the window and you're active and you're trading what the market gives you and you're taking you're taking your winners off the board, you have some profit target, being mechanical at 50% profits, whatever the number is that you're using, this is a really, really good market, as long as you can keep your risk low and you be humble about your opinion of tomorrow, because it is so random. Like, it is, at one point in time, we were so offsides it didn't even make sense, right? You're at a 22 multiple or whatever, and like, you just, like, this doesn't even make sense to try to stand in front of this stuff. Now that it's de-risked, you got half the market that believes they're going to print at some point. And so where do you want to be if they print? You got to be in something that's going to protect your purchasing power, which means you want to be an asset owner. And you got the other half that are thinking we're headed towards a period of deflation, and there's negative expected returns on every asset. And when you got half the market that believes we're headed towards a short-term period of deflation with negative expected returns on every damn asset, and you got the other half saying that they're going to print, there's no way out of this, they have to print, that means you've got inflation, that means you want to be an asset owner. Why wouldn't you see wild swings when there is zero consensus and the Fed is not alluding to one singular direction? They're pointing to, like, I got a gun to my head, I'm going to pull the trigger. We're going to go through a period of deflation no matter what. And you got the rest of the central bank saying we can't handle this pain. Why wouldn't you see wild swings? And as a trader, That's what you want to see, as long as you can stay small and be humble about your opinion of tomorrow. I think anybody that wants to dig their heels into their opinion and get super bold or bared up and super levered up, this market's going to find you and it's going to shake you. It's going to shake you out of your position. The only way you're surviving is if you don't watch the screen with any leverage.
Yeah, I mean, like, listen, I believe in having strong opinions, but in this market, you have to hold them loosely. You can't be married to anything. I like to use the example that we're speed dating here, Victor. We're not looking to settle down and start a family with any of our positions or trades. Yeah, you've heard me articulate very strong views and then flip course the next day, because quite frankly, if you're reading the short-term tea leaves right now, it is difficult. It is very much a random walk, as they might say. And to your point, this rally, what is it predicated on? This idea that the pace of hikes is going to slow down, that there's going to be a pause in early 2023. Thomas Westwater yesterday suggested that the market was beginning to pull forward rate cut expectations as early as May. Indeed, that does appear to be the case. May, June right now, are where the market's flirting with a potential first rate cut. It's not above 50% yet, but you're starting to see that market pricing come into the radar, if you will. But no Fed policymakers have argued for a pause, right? U.S. inflation data hasn't rolled over yet in a meaningful enough way to warrant this jubilant nature at the start of the quarter. So while there's been significant rallies, there are very legitimate reasons to think, why should I buy into the narrative that's been forming? And look at today's data. ADP beats expectations. ISM services is still quite strong. We're lining up for what should be another good U.S. jobs report on Friday, 200,000 plus easily. And if you see 200, 250K and the unemployment rate is still below 4%, do you think that means the Fed is going to turn around and change their tone and talk about slowing down the pace of rate hikes? Probably not. And it could just take Powell or Brainerd or one of these other high-level Fed officials to pour cold water all over this thing.
It's speaking to our point. I don't know if you saw, but I think Spot Gamma put out some data, or Wall Street Journal put out some data. I'm not really sure. I think it started with Wall Street Journal, but I saw it from Spot Gamma's Twitter. But the fact that the percentage of short-term option positions has gone up. It's like 50% of option positions have really short-term expirations, and I get it. I also get why, even in the face of these nasty rallies, that VIX isn't necessarily going down. You can almost just buy some vertical spreads at the 20 deltas in both sides and just wait for them to come for you. Eventually you're going to get a rally, you sell your winner, and eventually the thing's going to fade, you sell the other side. Or you can do it the flip side. I know you guys are going to barbecue me for talking about buying premium. You can do it the other way too, right? But it sort of makes sense. We did get some volatility contraction today, but not a ton, and realized vol is still elevated. So I sort of understand why that's the case. VIX still at 28.55. Let's talk interest rates, man. I'm going to slow walk this thing into energy, because that was obviously the big announcement. We're going to get to OPEC plus here in just a second. And I also watched that press conference, and I don't normally watch those press conferences, so I have no baseline for how to think about them. But in watching this one, I was like, oh no, this is nuts. This is not good. But anyways, let's go to interest rates for a second. Short term, 2-year, everything sold off from the short end to the long end. Short end at 420, a little bit over 421, 4.21. And the long end and the 10-year at 3.75 after coming off materially. We were down 18 ticks we were down 31 ticks, and the 30-year was down we were down more than 2 points at one point. We ended down a full point and 25 ticks. Your thoughts on interest rates, man? Was that just a reaction function to the potential of sticky oil inflation here, that there's a floor at $80 in crude? At least it looks like it in the short term.
I do think so. I mean, the long end of the curve is what reflects growth in inflation premiums, and what do we see coming out of this market today? You do see an inflation premium built back in with OPEC cutting their production, right? But you also see growth expectations going up. Here in the United States, Atlanta Fed GDP now, that's something that we like to talk about here, Victor. Where has it gone the last few days? It's gone up and away, 2.7% now for the third quarter after this latest batch of data. This is off the lows that we had basically a week or two ago, where we were flirting with 0.3, 0.4%. expected annualized growth. And that's in real terms. That's adjusted for inflation. So the U.S. economy right now is faring pretty well, pretty good, as they say. And if you're getting growth rates that look elevated now, inflation turning up, there's your growth, there's your inflation premiums built back into this marketplace. Long into the curve is going up here, but we're also seeing that the curve is not steepening as much because really what's changed with the Fed for the short end, right? They haven't signaled one way or the other that they're going to change their tack. That's a lot of people getting jazzed up about the JOLTS report in recent days. And perhaps because the Bank of England is doing these things and because the UN and the IMF are telling central banks to stop with their rate cuts, and maybe because we're going to see a bigger growth slowdown coming out of OPEC. As you talked about today, we were exchanging messages over Twitter. Perhaps it means that we need a relatively softer Fed. So a little bit of steepening there in the curve today, which is nice. Welcome. We want to see the curve get back into bullish territory, or rather above the neutral line, before we can actually say that a potential low is in for equity markets. But overall, I have to think the long end of the curve is mostly reflecting what we see in terms of U.S. data and with this announcement for oil prices. And Vic, if we could just quickly touch on this idea that the United States is going to ban oil exports as a way to prevent oil prices from going up further. That would probably be good news for the U.S. domestically, but it would be terrible news abroad, right? If crude oil is cut off from the rest of the world for Europe, Brent oil prices are going to spike. U.S. producers see more supply trapped in the United States. That's bad for crude. But if you are one of those people who thinks that the U.S. is actually going to do that, if those rumors begin to gather steam and ultimately both Democrats and Republicans want to embrace this, what I think is a crazy idea, there's probably a long Brent short crude pair trade somewhere in there.
Yeah, that's interesting. See, the thing about this inversion that's so weird, and I keep going back to Michael Cow and his bear steepening thesis, this idea that the way to get there with the least damage is to steepen up the curve through bear steepening, the long end of that curve. In other words, longer end interest rates start to raise, because in that world, it's more beneficial for banks. The banks they're freed up to do more lending and things of that nature. Because when the yield curve inverts, it makes it a very weird situation for banks. And I think that's at the core of what he's saying. Now, what you're saying is, if we get out of the flip side of that, though, is if we get out of inversions via bear steepening, interest rates are going to get they could be really high. And in that world, running deficits becomes even more painful. And then it just creates this other set of like potential volatility to deal with. So it's going to be, you just got to ride this thing out and hope for the best, quite frankly. I don't know. I don't know how to think about this, because if they're buying bonds in a good way, in a weird way, that's good, right? It means there's a demand for U.S. debt. It means there's a demand for what we're offering to the world. But that also means if the Fed's not changing their monetary policy anytime soon, that inversion stays. And in some ways, it could actually potentially steepen up, or the inversion could go deeper if that's the case. So weird world, man. We're in the upside down world. Let's talk crude oil, man. $88, up 27 cents ish. At least that's what my screen says, but it resets at settlement, so I don't think that's 100% accurate. The point is, we're at 88. We ended the session. Your thoughts on the OPEC cut and where we go from here?
We probably can see a little bit of a run right now in the very near term. I'm thinking about the last time we had a significant downtrend break in oil prices off of the June and the late July highs. That occurred on August 23rd. We went up from about $90.52 to a high of right around $97.50 in the ensuing week or so. Perhaps that's what's going to happen now, because we just saw the break of the trend line from the June and August highs, right? So maybe there's another few bucks here. But once we start to get into that 95, 96, maybe even 97 area, you have to begin to take a step back and think, like, can the market support oil prices this high? Is it something that can re-incentivize a new SPR release? As we heard from the White House, there's no plans for a new SPR release at present time. And we didn't hear that they were refilling the SPR below 80 either. But OPEC seems to have convinced the market that there's a floor here now. That we're not really going to see much lower prices moving forward, because if we do, they will continue to cut production, plain and simple. Certainly, you mentioned the other day, when OPEC puts out a rumor, it's one of those few things where, it actually happens. there are lots of rumors that go around in the market these days. We no better example than what happened with Credit Suisse over the weekend. Lots of rumors that they were about to blow up. Market wasn't going to open Monday because Credit Suisse was blowing up. But what happened? Nothing, right? Nothing yet, at least. But right now, nothing. What do we see here? Well, OPEC Plus floats this rumor out there. And not only do they deliver more. So I think this is a very clear signal that Saudi Arabia and Russia will act in a coordinated fashion to do what's best for their finances. Relationship with Europe, with the United States, be damned. And I think that means we're probably in a pretty fickle time. I think that means that we have to expect that, if we're going to see more energy come into this market, it's got to come out of the West. It's got to come from the United States. And do we think that we have the political environment to make that happen? Do you think the Democrats and Biden are going to turn around in the next few weeks before the election and say, drill, baby, drill? Probably not. So oil prices right now, I think, are tilted to the upside. Momentum is starting to improve on a technical basis. The conditions for a breakup are there. It's not a problem for stocks just yet, but let's see what happens if we cross that 90 threshold and we begin to look back at those late August highs in that 96, 97 area.
I should have dug into why he felt that oil prices would soften up in the short term. I'm sort of curious now, and that's been in the back of my mind. And I hate that I didn't ask the follow-up question. But on one hand, you had it's very difficult for me to try to follow where the administration is on energy policy. But at one point it was like, let's get gas prices down, right? Let's sell the SPR. Let's get gas prices down. Then at one point it was, let's let the market know that there's a bid at 80 so that we give confidence to U.S. producers so that they continue to produce and we don't exacerbate energy shortages. That theoretically is supportive of the price of oil. And then you get a cut here, which is also supportive. And I sort of know why the position is the way that it is. And, there's messages coming out of the administration that this was a bad move and it's misguided. It certainly seems like it was targeted and directed in many different ways, but I don't want to get into all that stuff. The point is the price went up.
Can I put on my tinfoil hat for a second?
Oh, I love a good tinfoil hat discussion.
I don't think that the Biden administration is going to care as much moving forward about gas prices. And I say that because if we take a look at gasoline futures and how they filter through to the broader market, it takes about 4 weeks. What's in 4 weeks' time? The elections. Mm-hmm. So if we take a look at the, RB, the RBOB gas futures chart, it's really a period where if we think about what happens into the election itself, gas prices probably stay low. And it's the week after or the week or two after the election, maybe even the day before the election, that gas prices start to rise. And by the time people are pissed off that they've seen gas go up 50 cents, $1 per gallon, the election's already be in the rearview mirror. So what incentive does the Biden administration have now? If people really feel that the only reason why they were using the SPR is because it was politically motivated, it was to help bring down inflation ahead of midterms. Well, now that that won't impact prices at the pump before midterms, why would they do anything else in the very near term? Why step back and not try to, waste dry powder in a market where the fundamentals are tilted against them, right? OPEC's cutting, so why release from the SPR right now? You're pushing into the wind. You're tilting at windmills, in effect. I don't know.
Yeah, I think I don't know. I think it sounds strong. My thing is, I don't really know that I care as much about how the administration is thinking versus I just care sort of, to be quite honest, like, how does that impact me and my life, my friends and my family? And what just happened today has the potential to make a difficult situation worse by increasing, in the short term anyway, the price of gasoline. And then what does that mean for our energy security, given the state of the current SPR? And, are we in a world of cooperation or competition? And this seemed like an emphatic stamp on the idea that we are in a competition world and we are no longer in a cooperation world. And there are, I think, impacts. And I think when you see the long end of the yield curve move down 2 points in response, maybe that's just trading, maybe that's just position, maybe somebody blew out, or maybe that's a market responding to that competition game, the emphatic stamp to the competition game, and the long-term implications of what that may mean for inflation expectations. We've talked about how inflation break-evens are highly correlated to the price of crude. They're highly correlated to the price of gasoline. And, you know, you start talking about these types of cuts, you know, it can change things a little bit. And I think you saw that reflected in the bond market today. You know, I'm telling you, yesterday you were killing me with the puns. Like I was dying yesterday with your puns, and today you got the tinfoil hat on. Oh my goodness. I mean, it's like, this is like, I'm in heaven over here. Let's talk gold and silver. They big sell-offs at one point, bit of a rally off the lows in both silver and gold. Gold performed much better today than silver. On the flip side, there was probably, I don't want to say this, I have no idea why it went down, but the point is you had a much stronger rally in silver, so it wouldn't surprise if you saw some of those people lock in some of those numbers, those paper gains, turn them into real gains. So more downward pressure on silver today, but both of those things came off the lows, man.
Yeah, you know, thinking about both gold and silver, I've long believed that these are, you know, as non-cash flow yielding assets, no dividend, no coupon, right? You're talking about something that's highly sensitive to U.S. real yields, right? They're effectively like Macaulay long duration assets. So what you see today is that U.S. real yields move back up, given what happens on the nominal side of things. Break evens don't necessarily do all that much, but the 10-year real rate right now is 1.515%. That's off last week's highs, but it was on Monday. You see a 28 basis point drop in real yield. So today you turn around, you get a 13 basis point rise. You basically cut in half some of what transpired earlier this week. So gold and silver, they come off a little bit. Silver prices for me, from the technical perspective, they've run into a little bit of resistance here. You're up at the August highs. More importantly, you're at a cluster of significant Fibonacci retracements on longer term charts, right around this, we call it 2065 up to 2090 area right now. But beyond there, then you begin to face former support, turn resistance now of the multi-year sideways range that was carved out immediately after the pandemic, basically, you know, July 2020 onwards. And that gets closer, you know, we're talking about up near 21 or so. From that perspective, yes, silver has had a nice rebound this week, but there is a lot of wood to chop here moving forward. That said, if we can chop that wood, we can get back into that range that was in place for, you know, a year or so after, you know, the pandemic, then you have a very reasonable technical basis to suggest that all the price action, all that deleterious negativity that's been in place since the start of this year, it was a false breakdown. And if that's the case, Victor, we're going to silver, baby. May not be this October, but you and I are having a steak dinner when silver trades up to 27, 28, because that would absolutely be on the menu, given the range that was carved out previously. So important days ahead, important weeks ahead for silver and gold prices. If they can maintain their elevation here, even just trade sideways, that time, trading is a function of both time and price when you're looking at charts, right? You have an x-axis, not just a y-axis, but your x-axis is time. So if you can trade sideways here and maintain this elevation and weather the storm a little bit, and you do get that turn lower in real yields because the Fed does pivot or signal a pivot later this year, early next, dollar comes off, you know, I begin to think that I like what I'm looking at. I'm not quite there just yet. I'm not ready to put some gold coins and silver coins in my pillow, but I may be there with you soon.
You know what? I think every day since last Friday, so this is what, Wednesday? I bought metals on physical metals on Friday. I bought physical metals on Monday. I bought physical metals yesterday. And I'll probably be I'd like to see a little bit more of a pullback. I got this I got this crazy bet on silver and gold upside by February and March of next year. A little bit of an upside bet in crude for 90. I think I'm in the 90, 92 vertical call spread or something like that for the end of the year, which is crazy. We're almost already there. But I think like the weird thing about this marketplace is I understand why so many people are using options to put positions on, because you can have much smaller capital exposure and you've got massive volatility. Now, the problem is if you're paying for those options, you got a 30 VIX, right? So you can end up losing some of that extrinsic value, even if you're directionally right. You can get some of that extrinsic value that comes against you if they bring down volatility on a directional move. But also in this market, this is me personally, I want as little exposure while having some directional or delta exposure in the direction that I want. Everybody's different. And, I know we've got Gamma in here, a bunch of vol sellers. They could care less, right? They're just selling the fear right now at that 30 VIX or at the 32, the 35 VIX, or, forward VIX future, whatever we want to use as your barometer or your measure. But we're all doing the same thing. You're probably legging out as well. So you're just trading the gamma of the market the same way I am, just a little bit differently. I can't believe we're talking gold again. Isn't that wild? I think everyone had given up. Everyone's like, this thing is stupid. It's like, it's just laying on the ground. You poke it with a stick. It never goes anywhere. Like this, and then all of a sudden those are the times when you're like, you know what? Why not take a bet on something like that?
Gold has a nice technical breakout here too. I mean, we're currently flirting with a break of the downtrend from the March and the August highs right now. If you're playing this through the options market, like you said, because volatility is so high, if that decays, if you have theta decay and you're using a short-term dated option, you're probably paying a lot of premium and it can turn against you very quickly. I mean, even if gold jumps 5, 10, 15 bucks from here, if you're trading, next Friday's option, for example, you still may not make money on it. So perhaps it's worth waiting for vol to come down a little bit. But again, the way I see this, if we trade sideways from here, and let's say the VIX and measures of volatility for gold come down, 15, 20% or so, and we've maintained our rally, I think that's a really good sign moving forward. And the options market becomes a lot more appealing to dabble in the very short term.
Wouldn't it be wild if VIX doesn't go anywhere this whole rally? Because nobody believes it. Everyone's waiting to buy cheap puts. And the vol never goes anywhere. You never get the opportunity to buy cheap puts, and you never believe the rally either. You get screwed the whole way. So eventually you get extended, and then you're just like, screw it, I'm just gonna buy expensive puts. and then the VIX goes from 30 to 45 on the move down, and you're just like, oh God. Or no, the opposite. Excuse me. It goes from 30. It collapses on the move down the same way we saw it at the beginning of the year. Wouldn't that be like poetic justice?
I mean, totally. I think people, again, going back to a recency bias, when you think about vol outside of limited events for much of the 2010s, you're hanging out below 20 a lot of the time. But what happened in the late 90s and the early 2000s? Vol is mostly above 20, around 30. You have events where it's going up into the 40s or so. Of course, this was very much the modus operandi during the global financial crisis and years after. But from 2012, basically through late 2020, VIX is hanging out below 20. Maybe this is one of those different regimes where we've locked into a different range. And so everyone expecting VIX to fall back below 20, like waiting for Godot, that's never going to happen. You're stuck in purgatory right now. And you're waiting for a guest that will never arrive.
That's why I keep thinking, what is the thing that everybody thinks will happen? And that most definitely will not happen. So everybody believes there's a very short bear market rally. Everybody's waiting to buy cheap puts on a VIX contraction. Like almost certainly none of those things are going to be true in the short term. Actually, we talked a lot about the dollar. A lot of it was not necessarily short-term directional in nature. A lot of that was sort of like the structural, the structure around the global reserve currency and the difficult situation we find ourselves in a highly leveraged global economy in a debt-based monetary system. That aside, let's talk random prices in the short term and try to make a story out of it. The euro, the dollar, after weakening yesterday, seems like gave that up a little bit. The dollar strengthened today. Euro fell below that buck, below parity again. What gives?
I mean, it's real rates in part. It's expectations of the Fed continuing to hike. Mary Daly, the San Francisco Fed president, was out today saying that she thinks we need more rate hikes.
Yeah,
she's supposed to be one of the more.
Did you watch that interview,
numbers.
or you read the transcript? Some of the stuff.
I did read some of the comments. Yeah. this week there's just so many Fed speakers. It's such a deluge, and it's going to be like this for the next several weeks because there's no October Fed meeting, and we're not going to hear from them officially in a formal capacity until November. So much for that meeting that Twitter was worried about on Monday, right? You know, we had those rumors going around about Credit Suisse and Deutsche Bank over the weekend, and you know, people are passing around this screenshot of Federal Reserve has a meeting, and because of the government's sunshine and transparency rules, we have to tell the world about it. Everyone's like, "Oh my God, I guess something really is breaking down." No, it's been on the calendar for several months. But the point is that we're just going to hear a lot of this noise. It's going to be difficult for the market to parse what they're saying because there's no forward guidance right now, Vic. I don't know how much people care, traders care, investors care about what individual Fed policymakers are saying. They're going to look at the numbers. We've seen some of these people's opinions get thrown away, you know, taking the baby out with the bathwater so often this year because they've just been so wrong. So I think a lot of the value in what they're saying has been discounted temporarily in the short term. This week, non-farm payrolls matters. And then we have CPI next week. And it doesn't really matter what Fed officials say in between then.
Yeah, I've sort of tried to tune a lot of that stuff out. You know what I mean? Because it's the same thing. Markets get a little strong, they'll start leaning on it. Markets are weak. The weird thing is they're not actually, this time I actually thought the message would be a little bit, they would get some dispersion in the message, maybe say some things that might soften up economic conditions in the short term, just given where we were. But that was not the case. We actually really did not see that. They've been sort of fairly hawkish in the rhetoric to what I've seen. But in fairness, I haven't really tried to keep up with it, quite frankly. There's no point at this anymore.
No,
It's just a big casino. It's just a bunch of people with 0-day options on every single day. And it's just a random, let's see what happens. That's all this is right now. It's a completely like narrativeless. There is no narrative. There's no function to what's happening every day. It's just massive realized volatility. And you either know how to participate in that and you stay small and you have an opinion, you don't get shaken out, and you have some solid risk management. If you're trying to tell a story right now, they're coming for you. You might as well just lay down because they're going to find you. Let's go to Bitcoin for a second, man. A little over 20,000. This thing is also another one that's just, this was the volatility sandwich, right? What's your favorite flavor of ice cream? Mine's volatility. Well, this was an amazing, this was a great ice cream cone for a very long time. And now we go into this period, and I don't know if this is a good thing or a bad thing. This is in my opinion, it could be emblematic of where we're headed for risk assets in general, where you get to this place, whatever that number is, right? And people hoping for this V bottom, they turn on the printer, whatever. What if we just go somewhere and now there's competition for risk assets, there is very little volatility, and this ends up, that grind with little realized volatility ends up being our fate. Part of me can't help thinking that is going to be the eventuality at some point, but looking at Bitcoin not going anywhere, going a couple of thousand above and below 20,000 is a far cry from the volatility we saw, 18 months ago, man.
Yeah, and even with this rally in risk appetite, Bitcoin's been trailing. I say that using ARK as a proxy because this week Bitcoin is up 5.3% right now. ARK itself, the innovation ETF ARK-K, as it were, is up 6.1%. So even in a market where people are reaching for a little bit more risk, cryptocurrency isn't necessarily leading the way higher. I find that to be very interesting. Perhaps it's because interest rates are so high. Regardless, I beat the same drum every day. Like perhaps there's a trade in here. Quite frankly, even if there is, it's been mostly range bound for the past several weeks. We've been bouncing around 20K. If I'm short-term trading, I hate range trading. I know that you could sell puts, you could sell calls, you could play the range that way. For me, this is where my performance over the years, and perhaps I should go back and revisit some strategies.
You're a Momo guy. You're a Momo guy. You're a momentum guy.
I'm a momentum monkey. I can't, I just get chopped up in ranges. I don't know what it is. I just never been able to execute successfully. So perhaps I need, that was when I was a much younger man. Certainly I was a much less experienced operator in the market. Maybe things would be different now. given all that I've learned from you and our guests on Jones and Friends, by the way. So I certainly have some new skills and new tools in my toolkit. But I will say that for me, the way this price action has shaped up for the past several weeks, it's just ugly. I dislike it. I wouldn't be trading this, even if I was a zero, DTE options trader. This would be something I'd be staying away from in GBTC or and any of the BITO, whatever short-term vehicle you want to use, the futures. It's just not for me, Vic. Not for me.
I'm actually the opposite. If a market moves one direction, those are really difficult markets for me. Like I'm the exact opposite, where I need a market to break and move, give it a market that's giving two-way action, not like this, but a market that's trending with two-way action is my favorite market to be in. Sideways a little bit would probably be my second favorite, and then a one-way train of momentum. I'm horrible in those because I'm waiting for the turn. I'm trading the turn most of the time, and if you never get a turn, I'm just going to get stopped out. That's all that's going to happen.
That's why you're the yin to my yang, Victor.
Yeah, that's a good point. I think you guys have definitely, there's probably a lot of people like me here. So like getting your macro point of view, getting Ilya's macro point of view, Daniel and all the guests that we've had, it really helps me to think about the potential risk in a marketplace for oh my gosh, you guys in the chat are killing me. Do us a favor. We got a lot of people in here again today. These people are insane. This chat is getting more savage by the day in a good way. There's a couple knuckleheads every once in a while.
You saw what I was laughing at.
Yes, I saw. I even approved it, by the way. Do us a favor. Hit the like button, everybody, especially this one. Whenever we get on guests, you guys have been super supportive. We start posting clips on Twitter, and you guys go in there and you help amplify that message. And one of the reasons we were able to get Brent on is because he saw Jem's previous video that you guys helped to amplify, which did crazy numbers on social. We kind of went viral, like mini viral a little bit. It's kind of wild. What a sick call he made all across the board. Sick
and Andy
call.
Too. Andy said that he was buying the clothes on Friday.
I know. I still got to get his clips out. Here's the thing. Think about what he said. He goes, Jem said, we're going to get he said, start dollar costing averaging long on equities. He said, rates are going to get pressure to 4 and then back off. He said, buy crude oil because no one's talking about the fact that this is all SPR led. And at some point, you're not going to be able to sell any SPR. You get upside again in crude oil. Like if you go down the line, it was the nastiest short-term call. And I get it that we're random, but for a random short-term point of view, that's kind of scared me a little bit. I'm not going to lie to you.
Not too bad. Not too shabby.
All right. If the people want more from you, Chris Vecchio, and I'm sure we've got some new viewers here who followed Brent Johnson, our earlier guest, special thanks to him. Tell the people where they can go to follow you. You're a finfluencer in your own right. I hate that word, but I love using it. Or if they want more of your content, where can they go, man?
You can always follow me here at Jones and Friends, Monday, Tuesday, and Thursday. Ilya is out for the high holiday today. He'll be back next week, but I'll be here tomorrow again, 4:30 Eastern, 3:30 Central Time. Of course, if you're watching the video, make sure you like and subscribe for more great content from Victor Jones and the Tasty Trade team. Vic, they can also follow me on Twitter at CVecchioFX, CVECCHIOFX. Come join the echo chamber where I retweet things that Victor puts out.
I can't believe I made it the whole way, man. I had a weird little stomach bug earlier today, and we were talking. I'm like, bro, I don't think I'm going to make it. Should we do reschedule? And we were like, no, we got to do this. And I'm so glad we did. And once we got into it, Brent's point of view is fascinating. Again, agree or disagree, I believe in this world, it's good to expose yourself to varying points of view. And unfortunately, that world, the places where you can do that is becoming fewer and far between. And I will be damned if this heads in that direction. I would like to be exposed to many different points of view, and I hope the audience that we're building feels the same. Hit the like button on your way out. You can follow me on Twitter at Victor Jones. Owen Jones is 0 because I like to be difficult. If you're watching this on demand a little bit later than the live view, do us a favor, leave a comment, tell us what you like. Hit me up on Twitter if you want as well. Tell me questions, guests, or topics that you'd like us to tackle. And be aware that when is it? When's Darius coming on? Is it next Wednesday or the Wednesday after? Let's give him a date.
think it may be the Wednesday after. We got to double check. We'll tell
Yeah,
everyone
no,
tomorrow.
it's Thursday. It's October 20th. So make sure
weeks.
tune in every single day. But we've got Darius Dale who's going to be joining us Thursday, October 20th. So it'll be another one, a special one with an extra special guest. And we just booked Daniel DiMartino Booth, who's going to be here on October 31st to give us on Halloween. So maybe we'll wear, maybe we should wear some cat ears and paint our nose black or something. All right, everybody. Until next tomorrow, same time, same place, same great network, only on Tasty Trade. I messed this up. I've been Victor Jones.
Having Chris Vecchia.
We'll see you tomorrow, folks. Peace.